This class is on the topic of capital budgeting. As you can see, it's part one of two parts. Now, capital budgeting. This type of budget looks to evaluate and select long-term investments that maximize the owner's wealth. So it's looking to long-term investments. It's capital budgeting, selecting long-term investments that maximize owner's wealth. So it selects and evaluates long-term investments. That's the essence of capital budgeting. Capital expenditure, sometimes abbreviated CapEx, outlay of funds by the firm that is expected to produce benefits over a period of time greater than a year. So we've also got a time dimension. It's not just expenditure on capital goods, investment goods, but it also, generally speaking, is over, say, 1 year. Anything less than a year would be more operational, would be more present day, more day-to-day running. So capital expenditure tends to be long run. Operating expenditure, sometimes abbreviated to OpEx, an outlay of funds by the firm resulting in benefits received within a year. It's also known as operating expense, operational expense, and operational expenditure. So operating expenditure is usually within the year. So we have a difference here, a difference between capital expenditure, normally aimed at investments that will increase owner's wealth in the long run, and that means, generally speaking, over a year, often over a longer period than that, sometimes over perhaps a 5-year period. But we can contrast capital expenditure and operating expenditure as is on the slide at the moment. Now, difficulties in capital budgeting. Well, the future is uncertain. Some economists say that the future is unknowable, usually associated with the great Austrian economist Friedrich von Hayek. But we can't tell what the future is with certainty. Things can change. The world can change. There can be innovations, change of governments. There can be natural disasters, wars. There can be all sorts of events that will affect our futures. So the future is uncertain, and investing in equipment or capital over a long period of time involves a considerable amount of uncertainty. The periods of costs and benefits are incomparable. We can't compare today with next year or the year after, because just for technology alone, the world is changing. It's changing very rapidly. And we know that the world we're living in right now will be out of date very quickly because of advances in technology. So we can't readily compare now with the future. And also, there are non-quantifiable costs and benefits. We don't know what the quality of life will be in the future. We don't know what society will deem to be good or bad about working conditions or about particular industries. For example, industries which are noisy or seen as polluting. Even though the industries are trying to tidy up the outcome of their activities, society may not condone them still. So we have all sorts of issues that can make costs and benefits non-quantifiable. We have all sorts of costs and benefits that we can imagine, but we can't know for certain because the future is unknowable. Now, the rationale for capital budgeting. Well, First of all, efficiency. Capital budgeting can lead to efficiency. A new machine presumably is more efficient than an old machine. It'll have more functionality. The same way as modern day cars are more advanced than, say, cars 20 years ago. They have more facilities. You can make a phone call from the car. You can listen to the radio or to digital music or whatever. So the car itself may be more efficient in terms of miles per gallon or kilometers per litre. So one of the rationales for capital budgeting in a business may be to improve the efficiency of the business by bringing in state-of-the-art technology. It also can expand revenue, although this is less certain. But modern technology can mean modern products or variations on existing products. And perhaps those variations can be implemented more quickly because the technology is more advanced. But as to whether, of course, the products are successful in the market or not, that is another story. It may be less certain. It could be that the technology, however, reduces costs, and that could be more certain because it may be possible to do costings. For example, knowing exactly what the costs are at the moment, say management accountants report that the cost of production is such and such, but if this new piece of technology was in place, then costs would be reduced. So having a capital budget which enables new equipment to come in may reduce the costs. Now, to distinguish between capital expenditure and operating expenditure, well, let's just take an example here, or various examples, and tick the boxes to see what they are. So let's start with a simple one. Let's say we have the purchase of a photocopier. Now, is it capital expenditure or operating expenditure? Well, the photocopier is a piece of equipment that will last over many time periods, and that's a clue. Because it lasts over many time periods, we can classify it as capital expenditure. It adds to output. It facilitates production. It facilitates the running of the business. It's not consumed in the production process. It's not like raw materials. So we classify it as capital expenditure. Now, what about the purchase of paper or equipment like toner for the photocopier? Well, that's operating because that's on a day-to-day basis. That's what is used day to day. Power and management. Well, it's operating because it's today. It's here and now. The power is consumed now. It's not bought now to be consumed in the future. And maintenance is right now. It's the maintenance on the machines. The machines are capital, let's say, but the maintenance is operational. It's ensuring that the machines continue to run. Establishment of a new plant, say opening a new factory or opening a new part of an existing factory, a new plant to engage in some sort of additional production or perhaps a new product line. Well, that's capital expenditure because it's aimed at producing benefits in the long run. Wages to workers in the new plant. Well, operational, because that's what they're working on. The acquisition of of a firm, the acquisition of another business. Well, that's capital, because it's investment, the purpose of which is to bring in a return over a long period of time. Training workers, that's operational. So training workers is operational. Training the sales force, that also is operational, because it'll bring in benefits more immediately, more here and now. The acquisition of a firm is long run. Wages to workers in the new plant is now. It's happening now. This is what has already been agreed or planned. Now, steps in the capital budgeting process. Well, proposal generation. What is the idea? What's been proposed? This really overlaps with entrepreneurship to some extent. Somebody has an idea to do something. It's an idea to buy a new piece of equipment that links to existing pieces of equipment, or perhaps introduces a completely new line. So there's a proposal, and that has to be generated somewhere by somebody. Then there's a review analysis, looking at whether it's a good idea or a bad idea. Based on the review, some decision has to be made as to whether to go ahead or not. And if they decide to go ahead, then it must be implemented. It must be carried out. And then there must be any follow-up on any issue that perhaps is not being delivered on time, or there are issues in implementation, or there are problems in implementation. There must be follow-up to make sure that all of the issues are ironed out, so that there is a smooth operating plant at the end of the whole process. Now, there are many aspects to this that we haven't really mentioned. For example, proposal generation, the idea itself, how it comes about, what inspired the idea, where did it come from. The review analysis could involve investment appraisal techniques, such as the net present value, or the internal rate of return, or the payback method. And decision making, to what extent can risk and uncertainty be reduced? Is there any way of reducing it? And how does the new equipment or the new idea fit with existing equipment or existing procedures? Implementation, how is the management structured to cope with this new development? What additional management are required, and how did they fit within the organizational structure? And the follow-up, who's responsible, and what's the time scale, and what will be the budget associated with this whole new activity? So this is part one of the capital budgeting process. Stop the video at any time, go back over, stop it at any time, make your own notes, pad out your own notes, and make sure you look at part two, which continues to develop the ideas in capital budgeting. So we'll leave this for the moment, and hopefully you will pick up the story in part two. In the meantime, thank you for watching.